Michael, let me begin with you. It's an unknowable question, but does it feel to you like yesterday may have been some sort of bottom?
We made a new low, Tyler, and therefore, sure, if that new low holds, there's a bottom. It certainly seems like it's going to be a two-day bottom. We can have a great deal of confidence as we say that. This volatility, it appears as if it will be with us for a while. That we have events in the Ukraine now complicating an already underway market adjustment towards a Federal Reserve that's going to be tightening monetary policy, and a market that's also coming up with a price adjustment to a post-pandemic, now new endemic world. It seems that that's happening. It's a lot to digest. So prices and volatility are changing, and I think a focus on balance sheets and good quality names with cash flow. It's important to be safe and make sure you're not sorry going through this sort of a transition.
I'll come back with some more thoughts on where to deploy capital right now, Michael. But
have you seen my Johnson & Johnson today?
I haven't seen Johnson & Johnson today. We'll get back to Johnson.
Up five.
Michael's favorite stock. Art, do you think that the selling pressure yesterday was some sort of flushing out of the selling pressure that has been there and building up?
Yeah, Tyler, it's such a great question. And when we look at yesterday's action, I really think you need to think about how much selling pressure we've seen literally for 2.5 months, right? So we started selling in December. Certainly technology, multiple compression happened in December after the Fed made its pivot and moved from transitory to tapering. And clearly we've seen multiple compression across all of technology, and in particular, the high-flying, high-multiple price-to-cash flow names, price-to-sales names. And I think that coming into January and into the first part of February, we shifted that concern or joined that concern with geopolitical tension, which escalated to the point where we had that crescendo-like selling yesterday on the open. And then investors really got very surgical and started saying, okay, which part of this trade is overdone? And it felt as though technology was the first part where that came in. Started with cybersecurity names, but it extended out to all of technology, which clearly came into the day oversold, became more oversold. And then on the other side of that, that cyclical energy trade obviously overbought because of geopolitical concerns. So I think we have a much more rational market coming into today and heading into next week. And obviously we'll shift our concerns back to what the Fed has to say in March on the 15th and 16th. But my guess is that overly hawkish environment that we're going through for most of January and into February about just what might they do has really ratcheted back down to a more pragmatic 25 basis points at a time, and let's become data dependent.
Let me pause there and ask you a little bit, Art, about inflation, because it doesn't seem that anything that has happened in recent days would do anything other than potentially intensify inflation pressures on energy, on industrial commodities where Russia is a major player, for example, titanium, platinum, and other things like that, as well as potentially agricultural commodities. So talk about inflation pressure here.
Sure. And that could certainly be the worst case scenario if the next tranche of sanctions actually incorporate things like Russia's ability to sell commodities, hydrocarbons, natural gas to the Eurozone, wheat, palladium, nickel, et cetera. We're not there yet. So, we'd have to make an assumption that sanctions get worse before they get better. And if you look at the commodities complex over the last 2 days, a lot of those prices have come down. We clearly have more demand than we have supply for energy product across the globe, and that will continue to be a problem. But, to the extent that that's going to escalate from this point forward, that's still an unknowable. And I think in terms of overall inflation, one of the things we have to contemplate as we get more normal in terms of doing things and getting out and about is that our consumption of services likely is going to get back to a more normal level where consumption of goods has been the majority of what consumers have been doing. So my guess is at the very same time that we're likely seeing commodity prices roll over and come down, we're actually going to have a more normalized pattern of consumption of services versus goods.